And networking never ends. It doesn't matter if you're 18, 48, 88, you're always networking, especially for your younger audience. If there's, folks that are in college that are listening to this, look around. Your classmates, these are going to be your future coworkers, your partners, your bosses, your clients. Like, this is your network.
Your network is your net worth. Come listen to some of the most successful people I know share invaluable knowledge, stories, and advice in real estate, business, and beyond. This is Weiss Advice. Whether you want to take your business or personal life to the next level, look no further. Welcome back to another episode of Weiss Advice. I'm your host, Yona Weiss. Excited to be here today with another great guest on the show. We have David Auerbach on the show, who is, I think, the first time that we've had someone who not only is an expert in the REIT industry, but also a director of a REIT himself, which is pretty impressive, and excited to talk to you today. But even more impressive is he is a Grateful Dead and Fish aficionado, which to me is just incredible. So great to have you on the show, David.
I don't even know how to top that. Thanks, Yona. That's great. I just got back from seeing fish this past weekend. So great to be here with you today. Thank you so much.
It's my pleasure. For our listeners who, before we dive deep into the REITs, what are a real estate investment trust, what that is all about and what you're currently doing, give us a little background on, how you got started in the industry and how you got started in real estate in general.
Sure. So my start's a little bit different than a lot of other folks. When I was growing up, to the tune of like 6, 7 years old, when kids are watching cartoons on TV before school, I was watching business news. I had been turned on by my father's CPA to the Wall Street Journal at a very young age, was fascinated by the stock tables and all the numbers. And that's when I learned about, publicly traded companies like Disney and the Boston Celtics. And I noticed at the time there was one stock price that stood out from all the others, and it wound up being Berkshire Hathaway. And I learned about Berkshire Hathaway and Warren Buffett at a very young age. And I realized so young, this is what I want to do when I grow up. I want to be one of those guys. I want to have my own stock ticker and everything. And side note, one of the reasons I was kind of nervous of getting into this industry is I was growing up as, like a teenager and going to college. I was afraid that if I was going to go into college and major, in finance and Wall Street, that one of the classes I would have to take, I'd have to memorize every single stock ticker. Like on my exam, the professor would be like, all right, what's the ticker for John Deere? And I'd be like, oh, no. I remember talking about that with a teacher of mine. The teacher goes, are you crazy? Like, what did I know? But I knew at a very young age I wanted to go on Wall Street. And so it helped set my path, for my college education at the University of Texas. It helped me get my internship when I was, graduating. And so I started out as a retail advisor, what we call a mom and pop advisor. My father was a CPA. He had a partner who rented space from him. He was a hybrid CPA/investment advisor. There are CPAs that do investment advising. And he was nice. He gave me an internship. He sponsored me. He hired me, brought me on board to get my licenses. And so I'm this, young graduated punk, 22, ready to go take over the world. I get a prospect that wants to have lunch with me. And I go tell him, hey, I'm going to go have lunch with this guy today. They want to sit down with me. He goes, no, you're not. I go, what do you mean? He goes, you want to go network, you want to go do marketing and stuff. That's on your time, not on my time. So if you want to go prospect, you have to do it after hours. You can't do it during market hours.
Interesting.
I'm like, but I don't understand. This benefits you. Like, this is AUM under your umbrella. And, this is me growing my book. And so, again, because I know everything at 22, I'm like, I was taught networking's a 24/7 gig job. Like, you don't turn it off. And if a guy says they want to have lunch with you, you go have lunch. And my boss was like, well, my shop, my rules. If you don't like it, there's the door. And I go, that's the stupidest thing that I've ever heard. You were wrong. Well, I got fired the next day. Literally, I got fired the next day. And still looking back on it all these years later, I still think it's the stupidest thing that I've ever been told in my career on Wall Street. And so for the time that I was, as we say in the industry, on the beach, back in the day, you may recall, the New York Times and the local newspapers used to actually publish classified ads, like job ads in the newspaper every day. And I remember responding to a 2-line, 2-inch font ad. It was like, got Series 7, Series 63, call this number. And I call the number and don't know anything, what I'm walking into, and I get invited to go sit in for an interview. And it wound up being the preeminent REIT research trading desk here in Dallas. The firm was called Green Street or Green Street Advisors back in the day. The trading desk was based here in Dallas. And the trader that I was replacing was going to work for the Bass Brothers out of Fort Worth. He was going to be their head trader. I would say that's a nice promotion when you can go trade for Kyle Bass. And, my boss was like, we need a junior guy, learn the business, fill the chair. And she's like, you check off all the boxes. You're great. You're hired. I'm like, oh, awesome. Okay, cool.
There you go.
And she's like, look, let me tell you right off the bat, and I'll never forget. I remember word for word. Kids your age don't get the opportunity that you're about to be given. She calls me a kid at 22, 23. I'm like, okay, sure. Sounds great. And, look, I started on the day that the market crashed in March of 2000. March 2nd, 2000 was my first day on the desk. She's never forgiven me for hiring me since I caused the decline in her portfolio. But in that 23, soon to be, next year, 24 years, I've literally gotten to watch the entire REIT industry evolve. Instead of it just being literally a handful of names, 10, 20 names that were out there that were widely followed, we're talking now, if you include mortgage REITs and some of these other sectors that are out there, well over 200 publicly traded companies. Mm-hmm. And so I was really privileged to grow up in the industry through tumultuous events like 9/11, the housing crisis of 08-09, the global economy collapse, COVID, all these different cycles. And, now here we are in this newest cycle. And, what do you and I have in common besides, focus on real estate and Wall Street? As investors, every single one of us are going through a rising rate environment. Nobody's ever experienced, interest rate hikes from 0 to 5% in basically a year's time frame. And so we're all learning on the fly together with this. But, I could have grown up and done taxes. I could have grown up and become an attorney or, a doctor, whatever it is. And why I was always fascinated by Wall Street, no 2 minutes are alike in a given day. News can come out in 5 minutes from now and send the market down 100 points to down 700 points. Or up 1,000 points, and it carries over for the next couple of weeks. Who knows? Like every single minute of the day on Wall Street's a new game. And so it's just so cool. I mean, if you saw my screens, I've got, screens and information bombarding me constantly. And it's my job to kind of filter it all out, filter through the noise and find the meat. Like, not to jump the gun, but we'll get into it. One of the things that I do is I find the news. I find the REIT news. I try to level the playing field.
Right.
So like there was this story that I missed this morning from my daily note. I caught it afterwards. But in Minneapolis last night, there was an apartment fire, which is obviously sad. You don't like reading about fires. It happened to be at one of our REITs in our fund. The article stated that 25 to 30 of the units are uninhabitable, and the company has not put out a press release or put out any notice about the story. And I put a blast out on Twitter. I put a comment out on LinkedIn. I have the news article for tomorrow's paper. But, again, that's clearly, I haven't even pulled up the stock price today, but clearly it's impacting the stock price when you have a fire at one of your properties. And so if we can bring all of this relevant information to people, you may not know the apartments, you may not know data centers, but as long as somebody's providing that wisdom to you, then you can become a little bit smarter investor. I always tell people to invest with your eyes. Look at the property, look, feel, see, touch, smell, observe. What's the parking lot look like? What does the sign look like? Is it missing a letter? Is it well lit? Is the property well lit at night? What's the foot traffic there? Right. And then when you start kind of connecting the dots and it's like, oh, I see that this is owned by Weiss Asset Management. Wow, I wonder what else Weiss Asset Management owns. And then you kind of really start getting into it. It's like, oh, wow. So who owns that shopping center down the street at the intersection of Main and Main? Because, man, that Starbucks is always crowded there. And, that's got to be a gold mine. Oh, well, that property is owned by Agree Realty. Wow, what else does Agree own? Mm-hmm. And then now that investor's got this spinning and they really go down the rabbit hole. And that's where I come in play. Because, again, I try to educate about the REIT sector in general. So that's my background from a very high level. I know I threw a lot out there, but let's get more into it.
Yeah, absolutely. And it was fascinating to hear how you got started, especially at such a young age, because like you said, that is a little bit of an anomaly. You don't have kids looking at the Wall Street Journal, stock prices every day. But, everyone is brought on their own path and given their own path. And it's amazing to see how you were able to, the providence really that put you in that right place at the right time and giving you those lessons at the early age, especially about the networking. I mean, that to me, I agree with you. Probably the stupidest advice anyone could ever have is, go to lunch on your own time, not the company's time when it's with a potential client.
And networking never ends. It doesn't matter if you're 18, 48, 88, you're always networking, especially for your younger audience. If there's, folks that are in college that are listening to this, look around. Your classmates, these are going to be your future coworkers, your partners, your bosses, your clients. Like, this is your network. And if you're able to go into that first job or second job with that network in your pocket that you're able to call upon for, whether it's an investment, a construction, whatever the sector that each of those people are focused on or industry that those people are focused in, if that guy's going to law school and they were the rising star, well, boy, I better look them back up 5 years from now because they're going to be the top talent at that firm. And if I need a lawyer, dude, that's the guy that I'm calling. And so never hurts to always be working on your network.
Absolutely. So I'm going to dive right into the deep end right now, David. Can you just tell us what a REIT is and what is the difference, if there are any, between investing in a REIT versus investing directly in a property?
Wow, that's a lot to bite off there because there's massive differences. So a REIT basically is just a tax structure. A REIT is a real estate investment trust. And at the end of the day, it's simply a tax structure. I call it a tax shelter vehicle. And the reason being is that if you are able to qualify through about 10 to 15 rules based off the number of shareholders, the property exposure, the income that's generated, blah, blah, blah. But the key rule of a REIT is that 90+% of the net taxable income that's earned by the property or the REIT itself has to be passed through to the shareholders in the forms of income. And that income is dividend. So really, that income is passed through to shareholders in the form of dividend. So for us, as a broad example, you see behind me, I have a sign here that says House, H-A-U-S. We run a residential REIT ETF. Our fund is comprised of 25 publicly traded residential real estate investment trusts. When I say rental, so we're focused on apartments, single family rentals, manufactured housing, and senior housing. So to really, make it as simple as possible, you're going to turn around next week and write your landlord a rent check. And you and millions of other Americans are about to turn around and write their landlords a rent check. Well, what's going to happen is the landlord at the end of the quarter, assuming it's a publicly traded company, is going to aggregate and pass through that income to shareholders in the form of a dividend. That's what it's really all about. So a REIT is a dividend income play. There's a reason why analysts, advisors, if you have a typical Wall Street asset allocation model, stocks, bonds, fixed income, international form, blah, 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 REITs and real estate are always going to represent anywhere from 5 to 15% of that portfolio. Because of that income that is generated by these investments. There's a reason why, as you go towards retirement, when you get into retirement, that an advisor is going to shift you more towards income producing vehicle investments, bonds, utilities, commodities, and REITs, because the ideal goal, the perfect situation, assuming everything lines up great, is that you want to basically live off the interest and dividends generated by the portfolio and never touch the principal. Right. So if I have hopefully a $10 million portfolio and I can generate, let's say $250,000 a year in interest and dividend income and never have to tap into that $10 million, that's a pretty good lifestyle depending on where you're living. Now, in New York City, that's a little bit different. But if you live in Wichita, Kansas, let's say $250,000 can go a long way. And so one of the things that finance classes, the REIT, real estate in general. By the way, for anybody that wants to learn about the REIT industry, go to REIT.com, REIT.com. It's the National Association of Real Estate Investment Trusts. It's like the Washington lobbying arm of the REIT industry, but they have a phenomenal educational platform that's on their website. Teaches you anything and everything you could ever want to learn about REITs.
Wow.
Why I mention them is there's a great chart. It's also in our investment deck if you go to our website, armadaetfs.com, but you could see what they call a glide path allocation. And what they're trying to encourage is that the further away you are from retirement, let's say you're right now in college age and you can retire, set money away for retirement. If you start putting REIT money aside today, like, buy, let's say, a monthly dividend payer that you could reinvest dividends, a DRIP, what a DRIP is, a dividend reinvestment program, that if you can buy a DRIP of a REIT at 18 years old and let that thing work its magic over the next, let's say, 50, 60 years, think about how much income you will have set aside by the time you reach that retirement age. So they're basically trying to say to you that this, the further away you are from retirement, hopefully the more that you're able to devote towards that sector, because again, that's how you're going to really bulk up that retirement income. Again, assuming all goes well in the market, right, blah, 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 dividends aren't cut, et cetera, but that you're able to take, 50 years worth of dividend income and upside market appreciation. And now you have a really solid chunk of change. Here's a very broad example. Just think of it this way. Stock's trading at $20 a share. A company pays an annual $2 dividend. Assuming all else remains equal, you will have recouped the stock price investment within 10 years just from dividends off the stock. And then you have upside appreciation potential in the stock price. That's a pretty sweet bet by just sitting back and letting these companies that have been around, some of these guys for 50, 60 plus years, that do what they do best. And you can literally just sit back like this and again, just kind of sit back and collect dividend income and not have to work for it. Like, that's a pretty cool thing.
Right. So I heard a lot about, dividend stocks and dividend investing. Obviously, REITs fit into that, that category as well. But ultimately, the companies, you talk about a REIT being a tax structure from the company's perspective, meaning the structure itself set up by the REIT, meaning the trust that is setting it up, the company that owns all of the properties that they do. And essentially what that is, from my understanding, is that the company X, right, owns X amount of properties and they pass all the, or 90% of the income from those properties they own to the shareholders as form of dividends, right? But in the end of the...
You talked about the private property example. I mean, if you, own... you and a buddy going on a house down the street as a rental property, and then you need to cash out, well, then either your partner has to buy you out, you buy your partner out and then sell it off to somebody, or you hope that, again, you recoup enough income off the underlying property that eventually you recoup your investment. And so there's like this public versus private REIT debate. And we're hearing stories about private REITs that have gated redemptions where investors can't get their money out. Well, it's almost kind of the same thing. If I own a share of an office building, how am I going to monetize the share of that office building if it's not trading in a public vehicle? The management, the LLC, the general partner, the limited partner, those guys can buy out one of the partners.
Right.
They could offer me OP units, which will eventually be, exercised. And so it's just the exit strategy is a lot more difficult on a private property ownership than it is through the public markets. Because again, a publicly traded REIT is just a stock. It trades during market hours. There's a bid-ask spread. You know what the volume is. You can track what the average daily volume is. You know when these companies put out earnings results or do a bond issuance or a stock deal. Again, that's one of the key things about publicly traded REITs is the transparency. They don't hide anything underneath the surface. Here's what we did. No, except for this fire. I'm sure we're going to see a press release today from that company that talks about that fire. But, they're very transparent in their business operations.
Yeah. And that's obviously a huge upside. I mean, obviously, like you said, it's liquid. It's a liquid investment. You could cash out at any time if you wanted to, like any other stock investment. But on the flip side, you hear a lot of people, wanting to invest in private equity or in deals, even though in syndications, which is very common among my listeners who are syndicators and are investing, there's a higher barrier to entry in a lot of those. You need to be accredited in many cases. You need to put in a large amount of money in many cases in order to get your foot in the door. The upside may be more in the end of the day, but obviously, like you said, the REITs give you solid kind of trackable dividends income that are pretty consistent with. Is that fair to say?
Yeah, absolutely. Because like you mentioned, some of those vehicles, we have like a 7 to 10 year hold, let's say, where you have to hold on to it. And, it is geared towards a particular segment of the investing audience. Kind of falls back on the joke that we always used to say, if you have to ask how much it costs to fill up the jet, you can't afford the jet. And so,
right.
For some of these vehicles where it costs a lot of money to get in, if you have to ask how much it costs to get in, you probably can't afford to get in. And so, there's other entities that are out there that are trying to, again, level the playing field, make it more attractive to the retail audience. But, I do my education towards what I call grandma and grandpa who live in the villages down in Florida. And if grandma and grandpa are tied up in one of these vehicles, and sadly, let's say one of them passes away and the spouse needs to pay for a funeral, but all the money is tied up in one of these vehicles and you can't get out, like, what happens there? As a side note, I was chatting with an advisor buddy, former client, and this topic came up, and he's like, wow, it's funny that you mentioned this. I have a client who's been trying to get out of one of these vehicles for 5 years. The client couldn't get out of the fund for 5 years, and they're still trying to get out. And, I feel awful for that person. I don't know how much money they have tied up in it, but still, if you can't get it out when you need to get out, like, that sends a ripple through the industry. And it just tells you that big guys or small guys, if this is happening, there's bigger problems that are out there.
Absolutely. I'm curious to backtrack a little bit. You talked about growing up in the industry and starting out, 20 years ago, there were only a handful of these REITs that existed. Now there's, over 200 or so publicly traded REITs. And that's pretty fascinating to me. What is it about that sector that there was so much growth over the past, couple of decades?
Yeah, so it's a variety of things. To start out, for some of the biggest guys, the only way that the biggest guys could grow is to acquire other companies. And so, when you're able to take a private portfolio public, like, let's use storage as an example, though there's some very large self-storage REITs that are out there, the self-storage industry itself is dominated by mom and pop players, local, neighborhood sharpshooter type guys. And so I always use this example that if Public Storage goes out and buys one property in Denton, Texas, do you know what it does to the bottom line for their earnings?
Probably nothing.
The answer, you're absolutely correct. The answer is absolutely nothing. It has no effect on the bottom line. But if they go out and buy 100 properties, okay, now we're talking something material here. I think also, as tech came out of favor in the early 2000s through the dot-com bubble burst, and with the proliferation of all of these different sectors and new booming economies and all this, growth of other platforms that are out there, it led to the growth of other REIT sectors. And what I mean is that if I had told you back in 2000 that we're going to have tower REITs and data center REITs, your first words would be like, what the heck is that? And the second would be, but it's not physical real estate. I don't understand. How is it a REIT? Or if I told you that there was going to be a cannabis warehouse REIT, or something tied to the railroads, or infrastructure like stoplights and, again, digital infrastructure, all this other stuff, it's like it kind of builds off of itself. So I have an office REIT. Now I have a Sunbelt office REIT. Wait a second. No. I'm just a New York office REIT, or I'm a mixed use. So the group just got bigger and bigger and bigger, responding to investors' needs. Plus, remember, some of these other funds and investors have held properties on their books for years and years and years. And so this is a way to potentially monetize these investments that have been sitting out for so long. Because, like, look, there's only one New York City. There's only one San Francisco. And so because of some of these markets that go like this, New York office is a great example, as we're seeing right now, it led to new office REITs coming to market. It led to a growth of net lease because we saw all of these new, Starbucks locations and Dunkin' Donuts expansions and gas stations, and the list goes on and on. Well, all these new players got involved in the space, acquiring all these properties. So the industry kind of grew up with the population itself. As we've grown, as we've developed more, it's led to the birth of more of these companies that are out there. And there's some great ones and there's some bad ones. And, I am not here to tell you buy, sell, hold, this guy's good, this guy's bad, because everybody invests differently. What makes a stock a buy for one guy makes it a sell for somebody else. And so it's important that every single investor do their own homework. There is no set playbook as to what makes a stock a buy, sell, or a hold. And since we all have different risk tolerances and profiles and, triggers that make us want to invest into a stock or sell a stock, you have to do your own homework, especially when it comes to the world of ETFs. I always say it's important to know what's under the hood of the car. What is driving that engine down the road? If I had told you in 2000, dude, I've got this great stock, it's called Enron, man, you got to go check this thing out. It's a high flyer. It's going places. Look what happened. And so it's very important, again, we're seeing this today, unfortunately, with, Carvana and, Coinbase and GameStop and AMC. And, again, I'm not calling these guys out as bad stocks or anything, but I think it's very important that you understand what is driving the operation. So again, I use that, the rent situation. I know where the rent is. I know where my income is coming from because it's the tenant that's paying the rent. The shopping center knows that the income is coming from all the tenants that make up the shopping center, but it's probably dominated by the grocery guy that's at the center of that, of that center, right? And Absolutely. So know where your income is coming from is also very important.
Absolutely. We could dive deep into this. Could be a 4-hour conversation, David. There's so much I want to learn about this, but it's fascinating to me. But I'm really very curious to know how you ended up starting the residential REIT that you currently manage, the Armada ETF, which is, like you said, an ETF, which maybe you can describe what that is for our listeners who may not be familiar, but essentially a portfolio of other REITs, meaning you don't own a REIT on your own at this point. Well, you do. Well, so now I'm confusing myself and the listeners.
Sure. All right.
Make sense of it for me, David.
So we manage an exchange-traded fund. A very simplified explanation is an exchange-traded fund is a market-traded mutual fund, or a mutual fund that trades during market hours. So if you own Fidelity Magellan's mutual fund, Fidelity, after the market closes today at 4 o'clock your time, at around 4:15, will tell you your fund is worth X today. Tomorrow at the same time, they'll tell you, hey, your fund is worth this right now. Our ETF house, you could pull up on E-Trade, Schwab, your favorite brokerage program, most likely, depending on who you use, but you could pull up a quote on our stock. You see what the bid is, you see what the ask is, what the underlying volume is. And so we trade during market hours. We are a REIT ETF. And so our fund has 25 publicly traded REITs in the fund. Gotcha. We don't own the properties. We own the companies themselves. And so now there's a difference between what they call active versus passive. Most passive funds are market cap weighted, meaning the biggest stocks are at the top, the smallest stocks are at the bottom, or they would equal weight. And so, we'll have 10 stocks with a 10% weighting each equals 100%. We're active. We are a REIT management team running this REIT ETF. So I've got a former REIT CEO we're working with. I've got REIT portfolio managers that spent 30 plus years in the REIT industry. I've got a REIT analyst that I'm working with. So again, we only know REITs. And so since we're active, our job is to what we call weight the portfolio. Who do we like? How much do we want to allocate towards them? What percentage of the pie? Who do we push further down? What's our thesis? What's driving the engine down the road? Well, our thesis is based off of 2 principles. Where are people moving across the country? And because it's so difficult to buy a house right now, and we can go into that, but which of those residential REIT segments and companies benefit from that relocation across the country? Gotcha. And so for us, we have like a Sunbelt focus. We like single family rentals as an example. And so we're going to weight our portfolio more towards the Sunbelt and single family guys than we would, let's say, upstate New York apartments as an example.
Right.
So, again, we control the weighting.
Gotcha. Makes sense.
That's what the REIT ETF is. So we just are a fund manager where we're trying to really, our job really is to, again, we're talking about dividend income based off of where people are going and which of the property types benefit. My job is to hopefully maximize the dividend income, the rental income that's being generated by these companies, which hopefully leads to a higher income in our investors, our dividend income in our investors' pockets.
Gotcha. Okay. That made so much more sense than it did in my head, or as I formulated it as the sentences that came out of my mouth. And I think from an ETF perspective, I think that's really what it is, essentially. You're owning different.
It's also a tax structure itself. Think about it. Would you do better buying 25 stocks yourself, timing the market, then having 25 tax bills to potentially deal with? Or what if I could put all 25 stocks into one little wrapper and now you've only got one tax event that you have to deal with?
Right.
That's pretty cool.
Yeah, definitely. Instead of investing, you're saying it's even better to invest in, house than invest on my own in these 25 other REITs.
From a tax perspective, but in the same breath, you could pull down my portfolio. Again, we're transparent. You can go to our website. You could see our holdings to the percentage of our weighting allocation. But you could be like, I don't like AIV. I don't want to own AIV. What are you guys doing? Why do you own this? And then, then you could own 24 names. So, usually I would say, if you like a particular name, go out and buy that name. That's great. Put your, stick to your guns. That's great. We're just trying to manage this portfolio of this little tiny sector of, for us, is it a REIT? Is it residential? Then it's going to be in this fund because we don't have home builders. We don't have hotels. We don't have Home Depot or Lowe's or anything home goods related. This is just pure play rental income generating REITs. And we're, again, on the residential side. Now, remember, all of the other sectors, the tenants do pay rent. Like if you own data centers, the guy that rents space at the data center is paying the landlord rent and it's being paid. Cell tower, great example. We got AT&T and T-Mobile and all the, Verizon. They rent space from these cell tower operators.
Right.
And again, those cell tower operators are paying you dividend income from those companies. Here's one more for you. I know we're running out of time because this has been awesome. You know how you buy a treasury bond, and the government pays you interest off of that bond.
Right.
Well, there's kind of the same thing in the REITs. There is a government-backed REIT. The company is called Easterly Government Properties. The ticker is DEA. And the only reason why I mention them is that DEA is an office REIT. Okay, so let's get that out there. Office. Oh no, office. DEA's tenants are like the TSA, the local FBI field office,
right,
the Department of Veterans Affairs for the veterans hospitals. So again, government service agencies are the tenant of DEA. And so indirectly, it's the government that's paying you that dividend. So just like the interest income you were out of Treasury by buying this potential stock, well more than 90% of the rent that's coming due is being paid by the government. You know what I mean? It's like, again, it's just, where's that money coming from? Know who your tenants are. I just think it's a very interesting story.
Yeah, that is fascinating. It's really, kind of two sides of the same coin. It's how you do it. So the final question before we jump into the final four, David, is probably the most important question I can ask you is, how does someone in Wall Street become a Grateful Dead and Phish aficionado?
We could spend a whole hour on that.
Maybe we should save that.
I was exposed to the bands at a very young age in my summer camp days. And, go to Jewish summer camp. Of course, they're going to be playing Grateful Dead and Phish. And so I was exposed to it at a young age. And being in Texas, which is not very jam band friendly, I got to go out and see a lot of the country. In fact, just because of our timing, today, right here today, is the 27th anniversary of my first Phish concert at Jazz Fest in New Orleans on April 26th, 1996. It also happens to be my mother's birthday today. That's how I'll always remember that. But special to be here with you today, celebrating my 27th anniversary of seeing my first Phish show. And just as a point of reference, I just got back from I saw numbers 200, 201, and 202 at the Hollywood Bowl in LA this past weekend. So 27 years, over 200 shows. And if you don't see me talking about REITs, probably you'll see me at a Phish concert.
That's pretty awesome. Pretty amazing. That's a pretty diverse kind of salad bowl you kind of throw in there, but I love it. That's amazing. So David, final four questions are, what is the worst job you ever had?
I have to be careful just because of how I phrase it, but I did work for a broker dealer exposed in the ETF industry that we were hired to build out his army, but no resources were put in place to help build out my army. And so as a result, I was working from like 4:30 in the morning Eastern time until about 6:30, 6:30 Eastern, then go home and do another hour of work,
Wow.
having clients call me at night doing stuff. It was really taking a toll on me. As I like to, I don't like to say, I mean, I was going down a dark road for a time. If I had been down that path, there's a good chance I wouldn't be sitting here having this conversation with you today.
Wow.
I would have burnt out and probably something bad would have happened. So I would say that was probably the worst job. And it wasn't the job. It was just the leadership at the job, because the team was great. I still talk to a lot of my former coworkers at that shop. Like, it helped me get to where I am today. So I always say, good things come out of bad situations. Sure. And I wouldn't be at Armada if it wasn't for being in that bad situation.
Sure. Absolutely. Amazing. Okay. Second question. What's a book you've read that's given you a paradigm shift?
I will bring it back to the REITs, because there's a phenomenal REIT history book that's out there. It's called Watch Out for That Rat Hole by Ken Campbell. And you can find it on Amazon and all your favorite. And the only reason why is that, I grew up in this industry of knowing these 20 companies and some of these big players that are out there. And it educated me about how those 20 companies got to where they were at, even before I even got involved with them. Literally the history of the industry, the legislation. And, for those that like to learn about what's happening in the history of commercial real estate, like, this is just a phenomenal book to read. There's just stories out the walls. I just saw Sam Zell speak at the NYU conference last week. Sam Zell's also got a fantastic autobiography. And if anybody ever knows Sam Zell, he's got a way with words. Let's just put it that way. That, like, you'll get through it in about a day and you're going to be like, wow, that guy. Like, you'll never look at him the same way. And so I like to read. It's just all I do is sit here and read every single day. And so when I do read, I try to go towards more like, I'm reading Howard Stern's greatest interviews, for my free time right now, to try to clear my mind out of the business speak. That's definitely opened my eyes up to some stuff. No question.
That's funny. That's fascinating. Okay. Third question. What's a skill you would like to learn?
Well, since I am a fan of Fish, I'd love to be a good guitar player, so I could probably practice my favorite songs or try to replicate my favorite songs. I like to be a better golfer. I'd like to get better at that. Also, giving back. I used to do a lot of stuff. Like, I used to be involved in my local JCC and stuff, and time got away from me. I was always taught to give back to the next generation. I had people help me get to where I'm at today. Yeah. I'm involved in a few mentorship platforms where I'm trying to give back to the next generation. And so, that's another thing that I'd like to try to learn, is giving back more of my time.
Absolutely. No, it's really important. I appreciate that. And probably the most important skill you can possibly learn is how to give back. That's the center of everything, foundation of it all. Fourth and final question. What does success mean to you?
Happiness. There's more important things than having money in the bank. If you're not happy, you will never be successful. I think going back to that previous gig that I was talking about before, it really kind of opened my eyes. And, I joke that, if my summer camp, or if I'm not seeing fish, I'm probably not in a happy place. I could have all the money in the bank, but if I'm not happy, it doesn't matter. So I determine success really is true happiness.
Absolutely. Love it. Finally, David, where can our listeners find you or reach out to you if they want to?
I'd be honored. So they can find me on Twitter. I'm Daily REITbeat on Twitter. You can find me on Armada ETF's website, D. Auerbach at armadaetfs.com. I'm always around to chat REITs, real estate, and ETFs, and my job is to educate. I love talking about this industry, as if you haven't already figured out. And I'm always down for a conversation. I talk to guys on Seeking Alpha, and people just randomly ping me on LinkedIn or Twitter, and I love this type of stuff. And so feel free to reach out to me should you ever have any questions.
Awesome. Well, it's really been a pleasure, David. I certainly learned a lot. So it's clear that you love what you do in terms of educating people, because I've learned a tremendous amount just in this short conversation, and it's really been a pleasure. So thank you for taking the time out today.
Thanks so much, man. I can't wait to do it again with you.
Yeah, we'll have to do a deep dive in the fish one of these days.
I'm game.
And finally, to our listeners, thank you guys for listening all the way to the end. Once again, and remember, the best advice comes only when you ask. Real quick, I have one question for you. Did you like this episode? If you did, I want to ask you a huge favor. See, the biggest thing that helps this podcast grow and that will spread this message to the whole world is that if you leave a review, a rating, and subscribe to the podcast. What that does is it basically tells the platforms that this podcast is out on is that you like my stuff and I'm doing something right. So take a few seconds out of your day, hit that subscribe button, leave a rating or review. I would be extremely grateful. Also, I want to hear from you guys. So I want to hear some feedback. If you have any questions for future episodes, please find me on LinkedIn, send me a DM, connection request, Yona Weiss, and I'd love to hear from you.